In this video, I will explain how to use premium and discount. Most traders use it the wrong way, get stopped out, and then the real moves happen. So let's get straight into it. So the first thing you need to understand when marking out discount and premium is identifying the correct range. And this is where most people mess up. You cannot just randomly throw a fib on the chart. You need a clear swing high and a clear swing low. I am usually looking for the most prominent move in the area I am studying, something that clearly created displacement and structure. Once I identify that swing high and swing low, I draw my fib from the high to the low if we are measuring a bearish leg, or from the low to the high if we are measuring a bullish leg. What this does is it defines the dealing range. Inside that dealing range, we now have a clear midpoint, which is the 0.5 level. That 0.5 level is what we call equilibrium. Everything above equilibrium is considered premium. Everything below equilibrium is considered discount. Now, extending that range left on the chart helps you visually understand where price is trading relative to that equilibrium. You can clearly see whether price is expensive inside that range or cheap inside that range. And that is important because we do not just want to buy or sell randomly. We want to buy at a discount and sell at a premium. But here is where it gets more advanced. There is never just one range inside price action. There are ranges inside of ranges. For example, you might have a major swing high to swing low creating a large dealing range. But then price creates a new swing low and pushes up. Now you have a smaller internal range from that new swing high to swing low. So price might be in discount on the smaller range but still in premium on the larger range. This is why higher time frame context matters. If you are looking for a large move, you need to align with the larger range. If you are scalping, you might focus on the internal range. Without context, discount and premium can become confusing. Now let's talk about why we even use discount and premium in the first place. The main reason is risk to reward. Let's say I go long exactly at equilibrium. I place my stop at the low of the range and target the high of the range. My risk to reward is about 1 to 1. That is not very favorable. But if price trades deeper into discount and I enter long closer to the low, now my stop is still below the low, but my target is all the way back at the high. My risk is smaller relative to my reward, so my risk to reward improves significantly. The same thing applies to shorts. If I short at equilibrium with a stop above the high and a target at the low, that is 1 to 1. But if I wait for price to trade deeper into premium and then short from a PD array in that premium zone, my stop is still above the high, but my entry is higher, which increases my reward relative to my risk. So practically speaking, if I am looking for shorts, I am hunting PD arrays in premium. If I'm looking for longs, I am hunting PD arrays in discount. Discount and premium are not entry models by themselves. They are positioning tools. They help you frame better entries with better risk to reward inside a defined range. And once you combine that with liquidity and structure, that is when this concept becomes very powerful. For this first example, we are going to look at NASDAQ on the daily chart. The first thing we need to do is identify a clear range. We can see a swing low right here, and then price legs up aggressively. So what I am going to do is mark from that swing low up to the current high that price is forming. That becomes our dealing range. Now, one important thing to understand about ranges is that they expand as price expands. As price continues making new highs, I am going to keep adjusting my range higher with it. In other words, I am tracking the active leg of the move. I will continue to extend that fib or range box upward until price finally puts in a confirmed swing high. So as price keeps moving higher, I move my equilibrium with it. Once we finally get a clear swing high, that is when I can stop adjusting the range. Now we have a defined high and a defined low. That is our completed dealing range. Now if we are looking for long positions inside this bullish context, what do we want? We want price to retrace into discount. Specifically, we want to find a PD array in discount. Looking at the chart, we do have a fair value gap sitting in discount. That becomes our area of interest. If I am bullish, I am not chasing price and premium. I am waiting patiently for price to retrace into that discount fair value gap. So now the question is, does price actually reach into that discount PD array? As price pulls back, we can see that it does trade down into that fair value gap in discount. That is exactly what we were waiting for. Price taps into the discounted area of the range, fills the imbalance, and then begins to move higher from there. That is the practical application of discount and premium. We define the range, wait for equilibrium and discount to form, and then look for price to react from a PD array in discount when we are looking for longs. For this next example, we are going to look at the dollar index, DXY, and how different equilibrium ranges interact with each other. If you notice, we have a strong move up. So the first thing I want to do is mark out the range that created the new structure. I take the high and the low that define that move and draw my fib or range tool across it. That gives me my equilibrium, premium, and discount for that leg. Now dropping down to the daily time frame, the question becomes, what are we looking for next? If we are bullish, we want to look for long positions. If we are bearish, we are looking for price to draw into liquidity for shorts. But inside this range, if we are looking for longs, we want PD arrays in discount. So looking into the discount of this range, what do we have? We can see a fair value gap sitting in discount. That becomes our area of interest. Instead of buying randomly, we let price retrace into that discounted imbalance. As we let price play out, we can see that it does exactly that. It trades down into the discount fair value gap. That is our first reaction point. Now, from there, something important happens. We create a new range. Price goes from this high down to a new low. That creates a fresh dealing range. So now we mark that out as well. We now have a smaller internal range inside the previous larger range. From here, if price is going to continue higher, we would want to see it react from discount again, or reach into premium of the previous range and reject. As the next day plays out, we get a reversal model. We sweep a lower time frame low, we break structure to the upside, and we get displacement. Now we mark out this displacement leg, from that high down to the low, giving us a new equilibrium. So once again, we ask the same question. If we are looking for longs, where do we want to buy? In discount. Looking left, do we have a PD array in discount? Yes, we have an order block sitting in discount. That becomes our next area of interest. As price retraces, it trades into that discounted order block and respects the opening price of that candle. From there, we expand higher again. Now that we have made a new high, we have yet another updated range. So we mark from the new high down to the low that created the displacement. That gives us another equilibrium to work with. If price pulls back again, we will once again be looking for discount inside this new range. And as the next day forms, we track the new high, adjust our premium accordingly, and watch where price trades relative to equilibrium. This example shows how ranges are constantly updating. As new highs and new lows are formed, you must adjust your equilibrium. There are ranges inside ranges, and understanding which range you are trading within is what allows you to properly align premium, discount, and PD arrays with structure. All right, so that wraps up discount and premium. The main thing you need to understand is that it all starts with defining the correct range. Once you have your swing high and swing low, equilibrium becomes clear. From there, it is just about positioning yourself intelligently. Longs in discount, shorts in premium, and always aligning that with structure, liquidity, and your entry model. Remember, there are ranges inside ranges, so always be aware of the higher time frame context before committing to a lower time frame idea. Hop into your own charts and practice marking out different ranges. Watch how price reacts around equilibrium. The more you do it, the more natural it will become. If this helped you, make sure you like the video, subscribe to the channel, and share it with someone serious about improving their trading. I will see you in the next one.